I still choose to believe the U.S. pork industry is a global leader. We have technical knowledge. We have a lot of comparative strengths in the global marketplace. So I don't think anything we're talking about here is the long-term demise of the pork industry. Don't overreact to that. But I do think there's some economic pain in the short term before we're able to regain, kind of more stable profit.
Hello, everyone. I'm Laura Greiner, your host for today's Swine podcast. And with me today, I have Richard Brock, who's the president of Brock's Associates. And I also have Glynn Tonsor with me, who is a professor at Kansas State University. Good morning, gentlemen. How are you today?
Good. Good morning, Laura.
Doing well. Thanks for having us on, Laura.
Well, I'm glad to have you both on today. Before we get started really talking about this topic, and it's a very important topic to talk about these days, I'd like to have you both introduce yourselves a little bit better than what I just did, just so that our audience knows a little bit more about you. So, Richard, let's have you go first.
Hey, I was born and raised on a grain and livestock farm in central Indiana, and went to undergrad at Purdue and grad school at Cornell in ag econ. And then I decided to go into the grain industry and ended up in Milwaukee, Wisconsin with a publishing and consulting company. And then in about 1978, I met Forrest Mars. I heard him give a speech. At the time, he and Millen family were rated the two wealthiest families in the United States. Mars, M&M's, Uncle Ben's Rice, cow can. Anyway, Mars hired me old man did, to be his personal commodity consultant, specializing in corn. They also involved the corn industry. And then 2 years later, he set me up in business, basically. And that's how I got going. And I stayed in Milwaukee when I quit my job with the other company. And so that's why we're there. And we thought about moving the company elsewhere. But today, we're a relatively small company, 21 employees. We manage grain sales for grain producers in over 800,000 acres. And we do risk management in the poultry and pork industry. Several of the biggest pork companies, I personally handle their corn and soybean meal purchases. And, that's basically what we do. We have 5 offices. Our primary one is in Milwaukee. We have another one in Destin, Florida, which is where I'm right now. And my summer months are in the Milwaukee office for obvious reasons. And so, I travel a lot. I do still do. I've been trying to cut back about 50 convention speeches a year. And so that's pretty much what we do. I am cutting back, and I've got other people that run the day-to-day operations of the company now. So I specialize basically in pork risk management and corn, soybeans, and cotton.
Perfect. Well, that's a great introduction. Glenn, how about you? Would you introduce yourself as well?
Yeah, so I grew up on a hog farm in Missouri. That's relevant for today as I empathize with the situation the pork industry's in. My PhD is actually from K-State as well, in agriculture economics. I was on the faculty of Michigan State for 4 years. And then since 2010, I've been back here at K-State as a faculty member. I spend probably 95% of my time in the research and extension realm. So conducting active research or engaging. Extension is educating those off campus, engaging with the meat and livestock industry. Almost all that falls in the beef or the pork space, working closely with quite a few stakeholders. I've had the pleasure to do one of these with you before, Laura, and if we don't mess it up too much today, we'll probably do a third one.
No, that sounds great. And I agree. This is always a good time to listen to individuals. And I like to hear the economics. It's something that I don't do every day. And so it's good for me to stay current as well. And so I look forward to this conversation with both of you gentlemen this morning. What we're really going to talk about today is, I think we'll first start with the U.S. banking crisis, talk a little bit about that, and then really jump into what we can do today for the U.S. pork producer as they're facing high input costs and currently low profit opportunities. And so maybe let's first just start with just the banking crisis. What is it and what really happened there? So I'll probably have Richard talk about that, I think.
Okay, I'll give a real quick summary. This happened, probably most of it happened in the third week of March. And there were several banks that had a crisis, but there were 4 primary ones. And the biggest one was Silicon Valley Bank in Silicon Valley, California. Very different situation than any other banks that most of us would work with. Silicon Valley, specialized in high-risk loans to the high-tech business and related industries. And what had happened is when interest rates were low, going all the way back to 2019, a lot of banks were searching and trying to grab for returns, trying to make any kind of money they could because rates were so low. So, and this was a very fast-growing bank, and they made, of course, hindsight's 2020. They made a strategically extremely bad decision into borrowing long-term, investing long-term into this money. To give you an example, there are two different routes most banks go to when they're growing and money's coming in. You can go either into securities that are available for sale immediately, or you can go into held to maturity securities, which means if you buy a 20-year bond, you got to hold it for 20 years before it goes. Well, they went from since 2019 to the end of 2022, they went from 14 billion in average for sale, which means you can cash them out anything, to 27 billion. But in their hold to maturity, they went from 14 to 99 billion dollars, and they were locking in, a 1.5% rate. Well, then when rates went up, the price of those bonds went down, and all of a sudden they were 21 billion in the hole if they were marked to market. There was a run on the bank. Smart investors knew what was going on, and so in a matter of 48 hours, they were done. And the government came in and bailed them out. Signature Bank and First Republic Bank had similar issues. And then, of course, there was Swiss Bank was the only international bank, and that was due to a lot of poor loans that had been made over a number of years, and also due to the interest rates. So, there was only a handful of banks, and if you take a look at the banks that most of the pork industry works with, I doubt if any. There might have been one or two that had loans with some of these banks, but I would find a very small percentage. And so in the agricultural banks, and I'm sure Glynn has as good or better handle on this than I do, but they're all in very solid shape. I don't think we have to worry about that. And so this was something that made a lot of news. I think is behind us now. If a bank was in this kind of trouble, it would have already come to surface by now, along with some of these others. So the ag lending, concentrated primarily in 10 large institutions in the United States. They're all very solid banks, and that's not really the issue. And as you mentioned, Laura, in the pork industry right now, our biggest concern is pork prices in the cash market this week. Just yesterday hit the lowest price since December of 2020. And you combine that with the fact that now producers are paying a lot more interest. I mean, the pork industry borrows a lot of money, and particularly operating capital. And when you go from essentially a 2.5% interest or 3% on your borrowed capital up to 7.5%, that changes your cash flows a lot. I mean, plus, the pork industry, along with many other industries, is impacted by the high labor cost. I mean, you can't avoid it. I mean, just people working in barns. The entire industry it's just been a very big struggle, and then we have all this pork coming to the market at the same time. So, I mean, the market is cyclical. The pork industry will work through this. I mean, normally supply problems take care of themselves. The interesting thing is pork is unlike corn. We're going to consume whatever's there. It's just at what price are we going to consume it? And so you get the price low enough, we'll consume it, we'll get the inventories down, and then we'll bounce back. But the short term here, it's going to be a squeeze, in my opinion, and look forward to see what Glenn's thought is on the same thing.
Yeah, I'll react to Richard gave us a lot there, which on balance I definitely concur with. The story of kind of how the quote unquote banking crisis, and we could even debate if it's a crisis because of how concentrated it was. I'm not sure it is for the traditional ag lending space, so I agree with that. For those that follow me on Twitter, I liked yesterday a Nate Kaufman tweet, just for reference, and Kaufman is with the Kansas City Federal Reserve, which is the reason I bring it up. And the Kansas City Federal Reserve is particularly focused on ag lending issues, just given the area of the country that they're based in and the states they look at. And there was a really useful chart that was summarizing new loans So there's an important distinction here is if you're operating on a loan that was, originated, say, 3 years ago, you still have a really favorable rate. But if you went into the bank yesterday and tried to open up a new operating loan, then consistent with Richard's point, you're facing probably at least a 4% higher rate than the year before. Something along the lines of 3.5 up to 7.5 is the change in the commercial bank loan rate in the last 12 months. So most operations are going to pay something above that. So a typical bank's going to put a margin on top of that. Altman's tweet has a nice bar chart summarizing that and so forth. But the punchline would be is if you walked in to open up a new operating loan today, you're likely facing a rate that's higher than it's been since sometime in 2008. So that is a notable jump. For context on impacts on margins, some of the information from Lee Schultz, who's kind of my partner in crime at Iowa State University, fellow geeky economist that quite a few listeners probably know of either directly or indirectly. And Lee's a friend of mine, so I mean that from a good way. He puts out profit margins, they're kind of estimates for a quote unquote typical Iowa system. I always interject, whether it's his resources or mine, there is no such thing as typical. So you need to know your own cost, right, to really take this next point further. But for context, market hogs that were leaving Faro to finish operations when the year started had about $3 per head of operating cost associated with them. If nothing changes from now as we go through 2023, and I'm sure something will, but just State of the Union kind of comment for a moment, we're going to add at least $1, maybe $1.50 per head on that. That's really important in any year, but it's particularly important, as Richard said, when the margins are adverse. So that same exercise that Lee oversees, market hogs that left the operation in February were sold at a loss of $45 per head, unless you had a manure credit. So if you worked with a crop operation, you got some credit out of your manure, and it was worth roughly $10 per head, but that just means it was a loss of $35 instead of $45 per head. So the margins are very tight. We're in a high cost relative to revenue environment for anybody that's producing pigs. And I don't think we're done with that squeeze. I would agree with that component of Richard's comments as well.
So let's talk a little bit about the pigs, and then we're going to go back to the interest rate for a moment. So what are some things that we've seen producers do in the past when we've had these types of adverse relationships, not so much the high interest rates at the moment, but when our operating costs and so forth exceed the amount of value that those pigs are selling for at market? And then what are some things that we should be thinking about doing here in the near future to offset that?
Well, I'll take a stab at it first. Like Glenn said, we're facing an environment right now we really haven't seen since 2008. And so we have a lot of people making management decisions that weren't even in the business then. And so, there's not a lot of history there to draw from as to how people are going to act and react to these type of adverse market conditions. But just out of the cuff, I would think that we'll see some cutback, maybe a little bit more culling of sows, slowing of expansion until we can get our supply side in order. I don't see that there's a whole lot of choice in that matter. Glenn will have a better handle on that than I would. But I just, I can't see that the pork industry is going to try to expand in this type of environment. The only livestock industry that expands in this kind of environment is a dairy industry, because somebody think about their monthly milk check. And if their milk check's going down, they have more cows. Makes no logical sense, but that's the way the industry's always worked, and that's the way it's happening right now too. They're in the same situation, and because their profit margins have deteriorated significantly in the last 6 months. So I think that's one of the ways we bail out of this is we've got to the industry has got to get their volume under control, and demand in pork, in my opinion, is pretty much inelastic. Beef is elastic, it impacts the price. Pork does not react to price. Most, the per capita consumption of pork has been, give or take 2 pounds, 50 pounds a person for as long as we've all been alive. If you're 3 slices a day bacon eater, you don't buy 4 if it gets cheaper. You don't cut back to 2 if it gets higher. I mean, it's just the way we are in the pork industry. And so most of our impact on prices is going to come from supply. And of course, our exports have not been as strong either since China's production has come back. And so, it will straighten out, but I think it's got to be something from supply. And so at that point, I turn it over to Glynn and let have his viewpoint.
Parts I would interject, I guess, to add to some of that is the decision to expand or further shrink the herd is broader than just the current interest and, even the immediate bottom line. My assessment here, we're in April of 23, is the regulatory uncertainty, the global environment for trade, and that's more important today than it was 3 years ago, and certainly than it was 13 years ago, for the prospects of prosperity. If you're a hog producer in the U.S., there's more great clouds on the regulatory as well as the global trade front than there was in the past. Now, I always interject, I'm going to choose to remain optimistic that we can remain a major protein producer and exporter, because we have a global comparative advantage there, and I think the world wants protein. But there's a lot of geopolitical challenges to realize that. And if you have uncertainty on that, that's going to give you a pause, because that's home to at least a fourth of the value of our system these days. Some of the regulatory uncertainty might get sorted out in the courts in the weeks ahead. But I'd be remiss if I didn't interject those points here as well. Richard brought up the comment about that we have a lot of people making management decisions that weren't around, or at least in a management position in 2008. I concur with that, but I'm going to put a shout out to the lending community itself. I'm guessing Richard was referring to the hog production side, management side, when he said that. I suspect there's quite a few loan officers, like your initial point of contact, that might be roughly my age. So I'm 42. I was born in 1980. I was not making those kind of major decisions for anybody in 2008, myself. The shout out would be, whether you are on the lending side of this or the hog production side of this, seek out somebody that's been there before. I think on both sides of that, you can learn from it. Now, that does not mean we need to do the exact same thing we did in 2008 or what we did in the 70s. I don't go too far with that comment, but there is value in experience, and we need to, update it to the modern realities after that. But that's a shout out to my fellow 40-year-olds and certainly 30-year-olds and so forth. Reach out and tap some of the experience. Specific to lending, there is discussions about, can you redo your long-term note, right, in a way to try to cover some of your operating costs and so forth. And this gets quickly into each individual's business discussions, but you can sort of spread out the shock of a higher operating rate note if you're able, with an equity position, to redo your longer-term, multi-year fixed cost notes. So those discussions are complicated. I think I made the comment last time I was on with you, Laura, go buy your banker a cup of coffee. It's definitely time to go buy your banker a cup of coffee. They'll probably buy it for you, but reach out to them. Be proactive. It's always better to visit with them, quote unquote, on your terms, and you be the proactive one, rather than waiting for them to come to you.
Yeah, that's absolutely a great point. And I think you both have raised some very good points, particularly around the fact that there are many people that have not been in this situation before. And certainly the situation in 2008 is different than what we're looking at today in 2023, with interest rates in particular being as high as we've seen in a while. So if we look forward a little bit, get your crystal ball out, where do you see us going? You've talked a little bit about supply and demand. I had circled as well trade and where trade exports are going. But what do you see happening in terms of interest rates and hog prices in general, in the next 6 months to a year?
Well, on the interest rate side, I think we're very near a top. I don't believe, I think everyone would agree the Federal Reserve reacted way too slow in raising these rates. They should have started a year earlier. But at the same time, they're getting some help from the fact that it appears we're going into a recession with all the layoffs in California. The high-tech industry led the economy up. Now they're leading it down. And the employment rate has gone up significantly in the West Coast. And that is putting the brakes on a lot of areas of the economy. And as a result, I don't think they're going to have to raise rates a lot more to help control inflation. The biggest part of the inflation has been labor cost, and that's probably near a top as well. So I think we're going to get some alleviation there. And so, and Glenn made a comment on interest rates. Whenever you have an inverted yield curve, which we do right now, our rule of thumb is you don't really want to be locking in long-term rates. You're going to have to bite the bullet short-term on the higher rates, but that yield curve will come in. eventually. And so you don't want to be locking in 20-year rates at these higher rates right now, in my opinion. And so that's it. But the other point that Glynn brings up that I think is extremely important right now is this great cloud on what's going on in the world right now, worldwide demand and the regulatory issue. Obviously, we need to increase our demand on the export side. We're pretty well locked in on what we are consuming domestically, and our expansion is going to be on the export side. So, if I were to put a time limit on this, you take a look at the long-term profit cycles in pork. I think we're looking at some relief, maybe in the fourth quarter this year, possibly in the third. But I think we're going to be in negative margins for the next 4 quarters, and then we'll come out of this. I mean, it's unfortunately bottoms are tough in profit cycles, and we really just entered this one, and so it takes some time to work out of it, and then we'll go back. I mean, Glenn referred to some work in Iowa State. They do some pretty good charts on the profit cycles and furrow to finish hog operations that I use a lot in our publication, and it's it takes a while to work out of it. We go through a period of high prices, then you go through a period of losses, and that's the way it's always been. And so it's going to take us a while to work out of this.
So, Laura, what I would add is maybe some additional resources to reinforce some of those points is I lead something called the Meat Demand Monitor project here at K-State. It is pork and beef checkoff funded. It's a large national survey of U.S. residents. Been going on over 3 years. The relevance of that for today's discussion is for about 6 months in a row now, we've seen importance of price grow in protein purchasing decisions, and lots of other related confirmation, I'd say, because this is surprising to me, but confirmation that households are tightening their budgets. So the typical U.S. resident is falling behind still today. The cost of living is outpacing the wages. Some of that's by design, but Federal Reserve and so forth. I'm not saying that's right or wrong. It's just part of what we're kind of living through. So that reinforces some of Richard's other points there. To the point on kind of where we're going, I'll try to interject some additional rays of sunshine. The industry is very resilient. So in my intro, I made the comment I grew up on a hog farm, and my high school graduating year was 1998. Well, 1998 will resonate with anybody that's older than me that's been in the hog industry for a while, because 1998 was a year where you basically couldn't give a pig away in northern Missouri or Iowa. That specific situation was we had too many market hogs relative to shackle states. And, that relationship is always important, but the industry adjusted and had periods of thriving thereafter. That's not to say it was without pain. There definitely was massive losses, particularly like December of 98. But those that were able to sustain their operations made some of the changes that we're alluding to here, and others, of course, were positioned to do well later. So I still choose to believe the U.S. pork industry is a global leader. We have technical knowledge. We have a lot of comparative strengths in the global marketplace. So I don't think anything we're talking about here is the long-term demise of the pork industry. Don't overreact to that. But I do think there's some economic pain in the short term before we're able to regain, kind of more stable profit.
Yeah, I agree with you both. I watch those charts too that come out and talk a lot about that with others of the highs and lows of the swine industry and how you try to hedge your losses and move forward and take opportunity where we do expect to have those profits. And so I do thank you both for your insight. And as I look at our time, we're actually getting close to the end of our time. And so before we jump into a couple of other questions, I'd like to ask you both to maybe give just a couple of quick tips or pointers that you would provide to our listeners today based on our conversation of things that they can do in the immediate future just to offset their potential losses as we move through this difficult time.
Well, couple of things. And I think, and we talked earlier, Laura, before we began, what we see as a key trait in a lot of people and what makes them successful in this kind of environment. And where my firm and myself, we're primarily involved on the risk management side of livestock operations. And my time in the last 2 weeks has been doing a lot of webinars with clients, and it almost all involves being able to make a decision. People think having the right information and right advice is the most important thing in managing risk. I don't agree with that. That is important to have the right information and right advice, but I find a lot of people have the difficulty making the decision. How do you take that information and make a decision? And I often refer to companies like Cargill. They give managers a profit center and they make the decision. They don't do it by committee approach. And I find too many times people do it by committee approach. And, there aren't many statutes built for committees in the country, and other than maybe the apostles. And, most statutes are built for individuals. And it is a unique trait. The people, I find particularly like, just say buying corn and buying soybean meal. People want to know for sure if the decision is going to be right. Well, you don't know if it's right the day you're doing it. And we can't make decisions by 20/20 hindsight. You have to know what it takes to make the decision. And I think we are in a key decision-making time frame right now in a lot of the industry. And for example, yesterday I did a webinar with a large feed customer client. And, I said, what we don't want to be doing right now is locking in protein prices. The protein market, in our opinion, is somewhat like the pork industry. It's in a downward spiral right now. Corn prices, unless we have some crop scares, we think corn prices are headed quite a bit lower. And it's the same thing true in soybean meal. So you've got to make those decisions. And unfortunately, I think a lot of people make a decision to buy it because it's cheaper than it was last week. Well, that's irrelevant. And so I just think the decision-making process is more important when you get it in market turns right now than it is in most other times of the year. And that's where we're trying to maintain our concentration with our client base.
So Laura, the one I would give that ties into today's theme in particular would be the more successful operators, whether they're the CEO level or just the price risk management level, wherever they are in this story, make decisions pretty much ignoring past decisions. So of course we're human, we learn from that. But if you failed to hedge and in hindsight you wish you hedged, or you did hedge and now you're beating yourself up, or whatever the example would be, the more successful folks are the ones that don't self-criticize over and over and over again. And in the environment we're sitting there right now, obviously had one went in and proactively protected the firm, right? It may not be as bad as it is if you're fully exposed to the market. It's still a negative margin, by the way, but it may not be as extreme. But that is not relevant for sitting here on Thursday morning, early April, to make decisions for going forward. It's human nature that we do that, and it's very tempting to do that. And as an active parent and husband, I'm guilty of doing that and lots of other things outside of today's discussion, right? We're human. But the successful folks are effective in not looking back. I mean, they try to learn from it, I agree, but they're really effective at looking forward. And that's hard. It's even harder when the margins are adverse and the stress is up. But frankly, it's even more important to do it when the margins are negative and the stress is up. So that will wean out some operators through this process as well.
You're both very good tips, gentlemen. Thank you very much for those insights and certainly your input today on markets and where we're headed and some suggestions on what we can do as we go forward.
It's time for our famous three.
Well, as we wrap up our time today, there's a couple of questions we'll ask you each comparative to what we're talking about. I'm not going to ask you your favorite swine resource, but rather I'm going to ask you if there are some additional resources that our listeners could potentially go to get some additional information as we go through this period of time.
Glynn, I'll let you lead off with that one. That's more your expertise area than mine. Because I remember referring to our own website, which would not be fair.
Yeah. Well, I'm sitting here wearing a K-State purple shirt. I'm on K-State payroll. So of course I got to say all K-State resources, but more seriously, we have a website here called agmanager.info where we cross-link a lot of things that are helpful for the broader meat and livestock industry. I referenced Lee Schultz at Iowa State, the decision maker website, and Richard reinforced a couple of those charts. Those are there as well. And I made a note earlier about the Kansas City Federal Reserve, so I'll bring it back a little more narrow to today's theme, at least kicked off on the banking situation and interest rates. The Kansas City branch of the Federal Reserve has an extra focus on ag compared to some of the other regional branches within the Federal Reserve. And they have a lot of good resources as well. I fully recognize not all our listeners on Twitter. That was a comment I made there. But, there are things posted to their website. They do symposiums off and on, things going on in the broader ag space. Sometimes they may not have something that's as narrow as fair to finish returns like Lee's resource at Iowa State, but the broader, environment for being an ag operator in the Midwest, they have a lot of good resources as well. So for listeners that just want broader education on the topic, it's not just the land grant universities by any means. Hopefully we're helpful, but it's also, the Federal Reserve and other allied partners as well that I encourage you to make use of those resources on the web.
We also rely on a lot of those that Glynn just pointed out. We'll go to his website. We'll go to Iowa State. We also use University of Illinois has a very good one as well. A lot of pertinent information at that one. And of course, I'm going to plug the www.brockreport.com if anybody wants to go to that and see our information. But I think the land grant universities do a fabulous job. And between Glynn and Lee, we use a lot of their charts and graphs, and I don't want to reinvent the wheel when it comes to doing that fundamental research, so we rely on a lot of their information.
And Laura, real quick, it's real important your listeners know K-State's basketball team made it further in the March Madness tournament than Iowa State and Illinois.
Don't mention Purdue, okay?
And Purdue is included. That's right.
Oh my!
I have friends at all the schools, so got to do that right now.
Absolutely embarrassing.
No, you guys, that cracks me up. We're not going to judge the ability to handle the economic crisis of swine industry based on our March Madness. Although I know, Glynn, you wanted to talk about that so badly today, so you got your plug in.
I found a way. Actually, Laura, a little more seriously, I do encourage our operators. There is a serious mental health component to this discussion.
Yes.
So I don't want to make light of that. And for me, watching basketball, because I'm a basketball geek, is a way to show out. I do encourage those that are listening that are financially stressed and they're subsequently stressed more broadly, find a way to shut down for a moment. And for me, that was watching March Madness. I teed it up from a joking perspective, but actually it's a useful education point, is find a way to check out and reset your head a little bit is really important in this environment.
One of the things we've heard a lot in some of these podcasts lately, when I talk about a trait that somebody possesses that's helped them be successful, I've heard a lot lately of resilience. And it's something that I think goes in here as well, is that trait of resiliency and managing these tough times. And however that resiliency shows up, it's important. And so, a suggestion like that, to find a way to release that tension, that stress, that just helps our resilience. And so I think that actually is a great suggestion, and it ties in very well to some of the traits we've heard recently. Are there any other traits along the lines of that you think might help somebody be successful as they go through this period of time?
I think Glenn's comment was very good, and that you got to find a way to relax. Although I'll say watching Purdue had a reverse effect for me. It added more stress than yeah, it was that bad. Anyway, but it is important to be able to clear your head and to try and be logical. And what I find in the risk management side, Glenn referred to this as well, you need to put your mistakes behind you. I find so many times producers say, well, I did that last year, I'm not doing that again. All they really learned was whatever they did last year didn't work. It doesn't mean it's not going to work this year. And the decision-making process can be fairly complex. And, a lot of people only do it as a part-time versus ourselves doing it full-time. And it really, I can normally recognize some issues right away when I start working with the producer group and how they're making their decisions. And some are very logical and very good. Some are very good. But I find it in times like this, and these are stressful times, in a lot of pork operations, the decision-making process gets confused. There's a lot of finger pointing if you've got 6 people involved in making the risk management decisions. And as once you get to that point, it's hard to keep a straight mind and have balance when you're doing it. So whether it's going fishing or whatever hobby a person might have, you need to get away from this now and then. But that doesn't mean putting off the decisions. Decisions have to be made.
The thing I would add, Laura, that I think is more relevant today than, say, 20 years ago when challenges like this, is looking beyond the optimal management of this pen or this barn. I mean, there's a lot in our system that does at that level for good reason, right? The more level we do that. But certain input cost lines or target output weights, so forth, might be a little more off the table to adjust today than they were 20 years ago. And I'm gonna point to labor in particular for a moment. So I would discourage us from thinking about making drastic changes on the labor front to save a penny. Now, use a penny to make the extreme point, but there are ways to reduce input costs by trimming inputs here and there and so forth. But I think with the broader challenge the industry has on getting labor, sustaining labor, keeping it showing up once you have it on payroll and so on and so forth, I think the labor category is less on the table for one to pitch a penny on today than it was before. Speaking to the production side in particular, the managing pork production. Conversely, maybe it actually makes sense to sell 5 pounds lighter than you ever thought you would, or some other adjustment in your system. So being aware of what your most constrained resource is, and I'm interjecting here, at least for some, it is labor. It's not the incoming pigs, it's labor. Think about how to optimize this in a stressful environment a little bit differently than maybe you would have 10 or 20 years ago. Because when things straighten back out, let's just say in 12 months for simplicity here for a moment, you're going to need labor. And I'm not optimistic that the broader U.S. labor situation is going to be a lot better in 12 months. So don't, handicap yourself 12 months from now by decisions today.
Great suggestions from you both. And I greatly appreciate all the information that you've shared today. And it's certainly been a pleasure visiting with you both. Again, for our audience, as we wrap up today, just to remind you of who we've been speaking with, this is Richard Brock from Brock & Associates, as well as Dr. Glynn Tonsor, who's with Kansas State University. Thank you both, gentlemen, so much today. We greatly appreciate it.
Thank you, Laura.
Thanks for having us on, Laura.
Imagine if, with a few key concepts, you could have the potential to create a massive positive impact by bringing from hundreds of thousands to millions of dollars for swine producers. Join us on this small group and go to the next level of swine nutrition on this 7-week-long elite online training in applied swine nutrition and feeding by myself and my world-class invited speakers. Additionally, you enjoy an exclusive community to exchange ideas. Go now to www.eliteswinenutritionist.com.